When it comes to building long-term wealth, most people dream about early retirement, financial freedom, and passive income. But here's the reality: without a smart plan, that dream can fade fast. What if I told you there's a way to grow your retirement fund automatically, without constantly picking stocks, worrying about market swings, or paying crazy fees? That's the magic of ETFs, exchange-traded funds, the modern investor's secret weapon for long-term wealth. In this video, we'll explore 5 ETFs that can help you build your retirement fund, step by step, backed by data, performance, and strategies used by successful investors worldwide. So grab your coffee, relax, and let's dive deep into the world of smart investing, where your money works for you, 24/7. What are ETFs and why they matter? Before we get into the list, let's make sure we understand what makes ETFs so powerful. An ETF is a basket of investments, like stocks or bonds, that you can buy and sell just like a single stock. They give you instant diversification, meaning you can own hundreds or even thousands of companies at once. That's less risk, lower fees, and historically, better returns than most people get picking individual stocks. ETFs are the foundation of long-term investing. They're like the engine quietly compounding your money in the background, the perfect match for retirement portfolios. And now, let's uncover the 5 ETFs that can make your retirement journey smoother, smarter, and stress-free. Number 1. Vanguard Total Stock Market ETF, VTI. If you want simplicity, stability, and solid long-term growth, VTI is your best friend. Vanguard's Total Stock Market ETF gives you exposure to the entire U.S. stock market, from massive companies like Apple and Microsoft to small and mid-sized businesses with room to grow. It holds over 4,000 stocks, representing nearly the entire U.S. economy. Expense ratio? Just 0.03%, meaning for every $10,000 invested, you're paying only $3 per year. Practically nothing. Historically, VTI has delivered around 10% annualized returns over the past few decades. That's powerful when you combine it with time and compounding. Let's imagine this. If you invest $500 per month in VTI for 30 years, at a 10% average return, you could end up with over $1.1 million in your retirement account. That's the beauty of broad diversification and long-term patience. Why it works for retirement. Low fees equals more money stays in your account. Massive diversification equals lower risk. Long-term growth equals stable wealth builder. VTI is not flashy, but that's what makes it brilliant. Number 2. Vanguard FTSE All-World ex-US ETF, VEU. Now, no matter how strong the US market is, it's never wise to keep all your eggs in one basket. That's where VEU comes in, the Vanguard FTSE All-World ex-US ETF. This ETF gives you exposure to global markets outside the United States, including Europe, Asia, and emerging economies like India and Brazil. It holds over 3,500 international stocks, with top holdings including companies like Nestlé, Toyota, and Samsung. Expense ratio: 0.07%, still very low. Why does this matter? Because the global economy is shifting. Emerging markets are growing faster, and some of the biggest opportunities for the next decade might not be in the US. Performance-wise, VEU has been consistent, offering stability when US markets dip. In retirement investing, that diversification cushion can help reduce volatility and smooth out returns. Imagine this balance: 60% in US ETFs like VTI, 40% in international ETFs like VEU. That global spread can protect your portfolio and increase growth potential over the long run. Why it's great for retirement. Reduces dependency on one market. Access to international growth. Long-term stability and diversification. VEU adds the global flavor your retirement fund needs to stay resilient in any market condition. Number 3. Vanguard Dividend Appreciation ETF, VIG. If you like the idea of getting paid while you wait, then you'll love VIG, the Vanguard Dividend Appreciation ETF. VIG focuses on companies that consistently increase their dividends year after year. Think of it as a who's who of financially strong, reliable businesses. You'll find names like Johnson & Johnson, Microsoft, and Procter & Gamble, companies that have weathered decades of market storms while continuing to reward shareholders. Expense ratio: 0.06%. Dividend yield: around 2%, but remember, those payouts often grow over time. Here's why VIG is a retirement superstar. Dividend growth stocks often outperform the market long term. They provide income even when prices drop, and they help protect your portfolio from inflation. Let's say you own $200,000 worth of VIG, earning a 2% yield. That's about $4,000 per year in passive income. As dividends grow, that income rises too, giving you a reliable cash flow stream during retirement. VIG is perfect for investors who want growth and stability, especially if you're planning to retire in the next 10 to 20 years. Number 4. iShares Core US Aggregate Bond ETF, AGG. Stocks are great for growth, but bonds are the key to protection. When markets crash, bonds help balance the pain. That's why every retirement portfolio needs some exposure to them. The iShares Core US Aggregate Bond ETF, AGG, is one of the best bond ETFs available. It tracks the entire US investment-grade bond market, including treasuries, corporate bonds, and mortgage-backed securities. Expense ratio: 0.03%. Average yield: about 4.5% as of recent years. AGG provides steady income and reduces volatility. It's not about making you rich, it's about keeping you calm when the stock market gets rough. A balanced retirement portfolio often includes something like 70% stocks, growth, 30% bonds, stability. And as you age, you can adjust that balance, adding more AGG to keep your retirement fund safe. Number 5. Vanguard Real Estate ETF, VNQ. Lastly, let's talk about real estate, one of the oldest wealth-building tools in history. But instead of buying physical properties, you can own a slice of the real estate market through VNQ, the Vanguard Real Estate ETF. VNQ invests in REITs, real estate investment trusts, companies that own and operate properties like office buildings, shopping centers, and apartments. Expense ratio: 0.12%. Dividend yield: often between 3% and 4%. This ETF gives you access to the real estate market without the headache of tenants, repairs, or property management. Historically, REITs have provided solid returns and high dividends, making them perfect for generating passive income during retirement. A small allocation, say 10 to 15% of your portfolio, can help you fight inflation and boost your income potential. Why it's great: tangible asset exposure, steady cash flow through dividends, inflation protection. VNQ adds that real-world stability that completes your retirement puzzle. The journey to building your retirement fund isn't about chasing the next hot stock or trying to outsmart the market. It's about having a plan, a simple, disciplined, and consistent plan that works for you. The truth is, most people underestimate how powerful steady investing can be. They believe they need to earn more, work harder, or take bigger risks. But the real secret lies in consistency, setting aside a fixed amount every month and letting your ETFs do the heavy lifting. Because every dollar you invest today is a seed for tomorrow's freedom. Let's think about it. What does retirement really mean? It's not just the end of your working years. It's about freedom. The freedom to wake up without worrying about bills, to spend time with your family, to travel, to give back, to live life on your own terms. And the 5 ETFs we explored, VTI, VEU, VIG, AGG, and VNQ, aren't just ticker symbols. They represent your ticket to that freedom. Just imagine this. You've been investing $500 a month since your 20s or 30s. You've stayed consistent, even when the markets dipped, even when the news made you panic. Fast forward 30 or 40 years. You wake up one day, and your portfolio is worth over $1 million. You didn't need to gamble. You didn't need to get lucky. You just needed patience and time. So start today, no matter your age, no matter your income. Set up your automatic investments, stick to your plan, and let compounding do the rest. Because wealth isn't built overnight, it's built quietly, month after month, year after year. So if you found this video helpful, then forget to like and subscribe for more financial insights. And remember, your future starts with a single decision today.